Welcome to this explainer. Okay, today we are unpacking a really fascinating piece of financial engineering. We're going to demystify exactly how a company figures out its fair share price right before going public. I mean, it sounds a bit like magic, but as you'll see, it's actually a meticulously engineered machine. Seriously, how do you price a stock that has literally never been sold? It's the ultimate mystery for a private company hitting the public market. Think about it. When you buy an existing stock, you've got price history, charts, moving averages, the whole shebang. But a brand new stock? Zero track record. If you price it too high, well, nobody buys it, and the IPO totally flops. But price it too low? You are leaving millions of dollars on the table. So how on earth does the market solve this? To figure this out, we aren't going to bore you with dry theory. No way. We're diving straight into a real-world case study using the red herring prospectus, basically the official IPO rulebook, for a company called Xtranet Technologies Limited. By looking at their actual offering documents, we can see exactly how this stuff works on the ground. And let me tell you, the stakes are massive here. Xtranet is aiming to raise up to 17,000 lakhs. Just to put that into perspective, that is 1.7 billion rupees in fresh shares. When you're dealing with that kind of money, you can't just throw a dart at a dartboard to guess the price, right? You need a bulletproof, incredibly effective system to find out exactly what investors are actually willing to pay. Entered the 100% book-built issue. This is the market's elegant solution to the pricing puzzle. It's a highly structured, super effective method designed to let raw market demand dictate the value. Instead of just picking a single fixed price, crossing their fingers and hoping for the best, the company opens up a bidding process. They literally build a book of demand, collecting bids to see exactly how much appetite is out there at different price points. Now, you obviously can't let people bid anywhere from 0 to infinity. You need some guardrails, so the company sets up what's called a price band. This gives us a floor price, which is the absolute minimum bid, and a cap price, the absolute maximum. Investors are then invited to step up and submit their bids anywhere inside that specific window. But here's a really cool detail about the regulations. You might be wondering, well, what stops a company from basically making the floor and the cap the exact same number just to skip the whole discovery thing? Well, the rules strictly mandate that the cap price has to be at least 105% of the floor price. It's a clever little rule that guarantees at least a 5% spread. It literally forces the market to do the heavy lifting and actually discover the true value. Of course, running a massive national bidding war isn't exactly a DIY project for a tech company. In our Xtranet case study, we have Share India Capital Services stepping in as the book-running lead manager. Think of them as the quarterback of the whole operation. And right alongside them is K Fintech, the registrar to the issue. They are the folks in the trenches, handling the crazy complex back-end data, juggling the applications, and ultimately pulling the trigger on allotting the shares. Okay, so how does the actual money work here? This brings us to a brilliant, highly effective mechanism called ASBA, Application Supported by Blocked Amount. Look, in the old days, you'd write a physical check, your cash would vanish from your account, and if you didn't get any shares, you'd be stuck waiting weeks for a refund. Not anymore. ASBA is a total game changer. You just authorize your bank to put a temporary block on the funds. Your money literally never leaves your account until you actually score the shares. It happens in 3 really clean, structured steps. First up, you, the investor, place your bid within that price band. Second, your bank steps in, often just using UPI if you're an everyday retail investor, and slaps a lock on those specific funds. And third, crucially, that bid gets officially registered electronically on the stock exchange platform. It keeps your money completely safe while making sure your bid is securely logged. But here's the catch, and it's a big one for the integrity of the whole book-building system: strict deadlines. The prospectus makes it crystal clear that there is zero room for error here. The folks managing this have precise cutoff times, like exactly 5 p.m. on closing day, to get those bids uploaded to the exchange. If that electronic registration is even a minute late, boom, the bid doesn't count. It's harsh, for sure, but it guarantees a totally clean, definitive end to the price discovery window. So the clock runs out, the valid bids are in, and the book is officially closed. But they don't just hand out shares to whoever showed up first. The regulator mandates this fiercely structured mathematical pie to keep things fair. The entire issue gets sliced up into very specific buckets for different types of investors. The biggest slice? That goes to the QIBs, qualified institutional buyers. Based on the rules in the Xtranet prospectus, a maximum of 50% of the issue goes to these guys. We're talking about the heavy hitters here: mutual funds, insurance companies, the big money.
Since they are bidding for massive chunks of shares, their demand is really the driving force behind discovering that final stock price. They do the heavy lifting when it comes to valuation.
But hey, here is where you and I finally fit into the puzzle, and it really shows how the market tries to strike a balance. Sure, the institutions drive the price, but the rules actually carve out a protected minimum of 35% specifically for everyday retail investors. Did you catch the phrasing there? The big institutions get not more than 50%, but we get not less than 35%. It's a great safeguard that guarantees regular folks get a fair shot at a hot new public company, even if the big guys are clamoring for it. Okay, so the bids are locked, the ASBA funds are safely blocked, and the investor buckets are set. Now comes the moment of truth. The company and the lead manager sit down, analyze this massive electronic book of demand, and figure out exactly how many shares were requested at what prices. This is how they finally nail down the ultimate issue price. If demand is just roaring, they'll probably price it right at the cap price. If it's a bit soft, they might stick closer to the floor price. And just like that, the book-building machine has successfully solved the pricing puzzle.
But hold on a second. Before we declare this a perfect, infallible science, we need a quick reality check. If you dig into the risk factors section of the prospectus, which you always should, there's a pretty stark warning. It explicitly says that the floor, the cap, and even that meticulously calculated issue price should absolutely not be considered a guarantee of what the market price will actually be once it starts trading. They make it crystal clear there is zero assurance of a sustained trading price after listing. Look, book building is incredibly effective for finding that initial launch price in a highly controlled environment, but it can't predict what the wild, unrestricted open market is going to do on day two. Once that opening bell rings, the stock is completely at the mercy of live market forces, news cycles, and global economics.
Which leaves us with a pretty fascinating question to chew on. We've just seen the incredible structure, the strict guardrails, the blocked funds, and the intense math that goes into discovering just one single share price before an IPO. Knowing how much mechanical effort goes into this highly effective process, does it actually make you feel more confident in how the market initially values a company? Even knowing the absolute chaos that might follow once it hits the open exchange? It's an amazingly robust system, but remember, it's really just chapter one of a public